Nvidia stock is currently trading at $215.02 during today's intraday session on Wednesday, May 13, 2026, marking a climb of 1.74% as the market processes a sudden shift in institutional sentiment. While the headline numbers look green, the reality underneath the surface is far more complex than a simple price jump. Most investors are looking at this $215 level and seeing a recovery from the March lows. But the real story is the massive divergence between retail expectations and what the largest funds are doing behind the scenes. We are seeing a significant rotation of capital, where high-frequency trading is masking a cautious positioning by the heavy hitters. The common narrative right now is that Nvidia is an unstoppable force in the AI chip sector. And while that is true on a fundamental level, the market has started to price in perfection. When a stock is expected to grow revenue by over 70% year over year, as management has guided for the current quarter, any small friction in the supply chain or a slight pushback in capital expenditures from the big tech hyperscalers like Microsoft or Meta becomes a massive risk. The expectation is that the AI build-out will continue at this breakneck pace forever. The reality is that we are entering a digestion phase where companies are still buying chips, but they are becoming much more strategic about how they deploy that hardware. This isn't just about who has the fastest chip anymore, it's about who can provide the most energy-efficient inference at scale. If you look at the trading volume today, which is hovering around 159 million shares, it's clear that the liquidity is there, but the volatility is telling a different story. We saw a high today of $223.75, but the stock struggled to maintain those levels as it approached the all-time closing high of $216.61 set back in April. This resistance isn't accidental. It represents a psychological barrier where many of the smart money players are taking profits before the upcoming fiscal first quarter results on May 20. There is a palpable tension in the air. Investors are asking if the easy gains have already been made, or if we are just at the starting line of a multi-year expansion. For anyone using platforms like SoFi Invest or Interactive Brokers, you've likely noticed the intense focus on semiconductor sector momentum lately. The sector as a whole is navigating a paradox. Demand is at historic peaks, yet the industry is so heavily weighted toward AI that any cooling in that specific subsector could send shockwaves through the entire individual brokerage landscape. We are seeing Amazon and Alphabet ramp up their own internal chip development, which is a direct challenge to Nvidia's dominance. While Nvidia still holds the crown, the moat is being tested by custom ASICs and TPUs that are specifically designed for the workloads these tech giants care about most. Let's talk about the institutional activity, because that's where the real divergence lies. While retail traders are piling in on Robinhood, large institutions like State Street and Norges Bank have been slightly rebalancing their portfolios. They aren't necessarily dumping the stock, but they are moving toward a more neutral stance as the valuation stays around 44 times earnings. For a company growing this fast, that multiple actually isn't as crazy as it sounds, especially when you compare it to the historical average of over 60. But in a high interest rate environment where the 10-year yield is sitting at 4.41%, every point of PE matters. The market is no longer giving a free pass to growth at any cost. I want to hear from you on this. Comment below how many shares of Nvidia stock you currently hold and whether you plan to buy more before the May 20 earnings report, or if you're waiting for a pullback. The core of Nvidia's business model remains its data center segment, which now accounts for over 90% of its total revenue. We are talking about $62.3 billion in a single quarter from data centers alone. This is unprecedented in the history of the semiconductor industry. The company has successfully transitioned from being a gaming chip company to the backbone of global computing infrastructure. Their upcoming Blackwell and Rubin architectures are expected to drive sequential growth throughout the rest of 2026, with some analysts predicting that the total addressable market for AI accelerators could hit $1 trillion by the end of the decade. However, the risk isn't just competition, it's also geopolitical and macroeconomic. The recent volatility in energy prices, with crude oil jumping due to tensions in the Middle East, is a direct headwind for the massive data centers that house Nvidia's chips. These facilities are power hungry, and as electricity costs rise, the ROI for the companies buying these chips starts to get squeezed. Furthermore, the trade restrictions regarding China remain a wildcard. Even though management has guided for zero revenue from Chinese data center compute, any further escalation in trade policy could affect the broader supply chain, particularly the advanced packaging facilities in Taiwan. When you look at the broader market context, including how Apple stock or Tesla stock is performing, you see that Nvidia has become the de facto leader of the Magnificent Seven. It is the engine driving the S&P 500. If Nvidia sneezes, the whole market catches a cold. This puts an incredible amount of pressure on their upcoming earnings call. They don't just need to beat expectations, they need to raise guidance significantly to justify the current rally. We've seen in previous quarters that even a beat and raise can sometimes lead to a sell-off if the whisper numbers among analysts were even higher. The future outlook for the stock depends on whether it can break through that 220 resistance level and hold it. If we see a successful breakout, 250 is the next logical target. But if the earnings report shows even a slight deceleration in data center growth, we could easily see a retest of the 180 support level. This is why many investors are turning to tools like Schwab Intelligent Portfolios or Fidelity Wealth Management to help balance their exposure. Going all in on a single stock at these valuations requires a high tolerance for volatility. One interesting development is the shift from AI training to AI inference. Most of Nvidia's growth so far has been driven by companies building their large language models, but as these models become operational, the focus shifts to running them. This is a different type of workload, and it's where the competition from custom chips is most fierce. Nvidia's response has been to integrate more software and services into their ecosystem, making it harder for customers to switch even if a competitor's chip is slightly cheaper. They are building a platform, not just a product. As we move toward the end of the second quarter of 2026, the theme for investors should be cautious optimism. The fundamentals of the company are stronger than they have ever been, with net profit margins exceeding 55%. That is a level of profitability that most companies can only dream of. But the stock price is a reflection of the future, not the past. The market is betting that Nvidia will continue to dominate the AI landscape for years to come. The tension between that expectation and the reality of increasing competition and macroeconomic headwinds is what will define the stock's performance over the next 6 months. In summary, the intraday movement today shows a stock that is fighting to stay on top. The $215.02 price point is a battlefield between those who believe the AI boom is just getting started and those who think we are nearing a local top. We've explored how institutional movement is diverging from the retail narrative and why the moat around Nvidia's business is being tested from multiple angles. Whether you are using a Robinhood app for quick trades or a more robust Fidelity trading platform for long-term holding, the key is to watch the May 20 earnings call with a critical eye. Expectations are high, but the reality of the semiconductor cycle is that it is notoriously cyclical. Nvidia has managed to defy that cycle for several years, but as it becomes a larger and larger part of the global economy, it becomes more susceptible to the same forces that affect every other industrial giant. The growth is there, the demand is there, but the price of admission has never been higher. Authority in this market comes from understanding these nuances, not just following the green bars on a chart. As always, keep a close eye on the volume and the institutional positioning, because that is where the real truth of the market is hidden. The central insight here is that Nvidia is no longer just a chip maker. It is a barometer for the entire digital economy. The contrast between the aggressive growth guidance and the growing caution among institutional investors creates a unique setup for the coming weeks. We are in a high-stakes game, where the winners will be those who can separate the noise of daily price swings from the structural shifts in how the world processes data. Stay focused on the long-term catalysts, but never ignore the short-term risks that are currently being masked by the broader market momentum.